doesn't suit China to shoot themselves in the foot by invoking the nuclear option of openly dumping treasuries. And what is becoming clearer, though, is that China has, through their secretive shadow banking operations, been stealthily converting a large percentage of these hidden 3 trillion of largely dollar FX holdings into physical gold. And once this is ultimately revealed, the price of gold will far exceed Saxo Bank's $3,000 per ounce 2024 estimate, likely placing this as a floor to actually rally off.
Bloomberg Commodity strategist and other leading experts have predicted that gold prices could rise by 50% in 2024. According to analysts, gold is forecasted to reach $2,700 during the first half of 2024 and eventually hit $3,000 by the end of the year. Most commodity strategists explain that gold could begin 2025 trading at $3,000 an ounce. AndrewMaguire, independent London metals trader, and Analyst predicts China's covert gold strategy will push prices beyond Saxo Bank's $3,000 estimate, sparking a substantial rally. He mentions a Bloomberg report stating China's reported $3.24 trillion foreign exchange reserves could be closer to $6 trillion, raising transparency concerns. Data released by the State Administration of Foreign Exchange, SAFE, on Sunday showed that China's foreign exchange reserves reached $3.238 trillion as of the end of December, up 2.1% month-on-month. However, Maguire draws attention to China's discrete dollar-to-gold conversions, aiming to reduce U.S. dollar debt and secure FX reserves in the face of geopolitical uncertainties. Given the impact of the U.S. Federal Reserve's monetary policy on the global economy and financial stability and Western countries' weaponization of the U.S. dollar by Western countries, China needs to continue increasing its gold holdings to further enhance the security of its foreign exchange reserves. In 2023, the central bank announced a 225 tons increase in their gold reserves, which reached 2,235 tons by the end of December. Gold now accounts for 4.3% of the nation's official foreign exchange reserves. During the past 14 months, China's gold reserves have risen by 287 tons. Moreover, Maguire hints that 30,000 to 40,000 tons of undisclosed gold may be 40% of China's reported FX reserves, emphasizing China's secretive gold strategy. Now, we present the clips of AndrewMaguire's insights from his recent interview with Kinesis Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Brings us on to a little reported Bloomberg report, which draws unwanted attention to former U.S. Trade and Treasury official Brad Setzer assessment that China's reported U.S. $3.24 trillion of foreign exchange reserves are just 50% of what he estimates, estimating that the PBOC's reserves total closer to $6 trillion, which he expressed as, quote, presenting a new risk to the global economy, end quote. Now, Setzer is concerned that China's lack of transparency is a problem, remarking, and there's a quote here, which is directly his words, because China structurally is so central to the global economy that anything it does, seen or unseen, will eventually have an enormous impact on the rest of the world. His comment. Now, as reported by Setzer, around half of these additional over 3 trillion of unreported shadow bank reserves are salted amongst the state commercial lenders and the policy banks. However, our focus is on gold. And given that monetary gold reserves also categorized as foreign exchange reserves, the question is, how much of this massive multi-trillion shadow banking pile salted inside the state-held banks comprises of FX gold that has been converted into physical bars? Now, our well-connected Chinese contacts have for some time been reporting these stealthy dollar-to-gold conversions, and they stepped up in 2010, but they really ramped up after the dollar was weaponized against Russia in March 2022. And it makes sense that these FX conversions have been channeled into fungible and highly liquid bullion, achieving really two major things: stealthily de-dollarizing, converting incumbent US dollar debt into fully paid for debt-free bullion without raising a red flag, alongside sanction-proofing trillions of dollars of Chinese FX reserves that could, in a time of war or even in the change of an administration, which is possible, be weaponized against China. In fact, it is most likely that a very large percentage of these excess reserves now sit in the form of a massively unreported multi-trillion-dollar gold bullion hoard. And while the exact level of unreported bullion holdings is impossible to auditively lock down, the potential is that these unreported state-held shadow bank holdings could equal between plus or minus 40,000 tons, which brings us full circle to jiving with our contacts' observed estimates. There is no other plausible way that China really could, under the radar, have accrued this much bullion in exchange for dollars without drawing attention to this de-dollarizing process. Our well-connected Chinese contacts aside, the average of multiple credible sources have estimated China's gold reserves really constitute something around 30,000 to 40,000 tons of gold, which, to stay on the radar for now, are salted amongst these state-held banks and could be crystallized with a click of a mouse. This conservatively suggests that the percentage of gold that backs the aggregate total of reported and this is Setzter's reported 6 trillion assessment of China's FX reserves is plausibly closer to a staggering plus or minus 40%, alongside what could be estimated to constitute the highest global to GDP ratio of all central banks, multiples of the European gold to GDP average of around 4%.
During the interview, AndrewMaguire warned of potential chaos in the silver market if gold prices are revalued. He argues that silver, being the most undervalued commodity, relies on a ratio trade that a gold price revaluation would disrupt. While the real significance of the gold-silver ratio is the subject of intense debate, there is a historical relationship between the price of gold and that of silver. In general terms, silver prices will follow as the price of gold moves up or down. Some specialists trade based on the GSR. Buying or selling as silver is expensive or cheap, relative to the current price of gold. Furthermore, he expected that gold price revaluation might collapse derivative markets, prompting a revaluation of silver contracts and causing chaos. Let's get back to the interview.
The fallout of a gold price revaluation will implode the synthetically priced silver market completely. Currently, in order to control one 5,000 ounce contract of silver, the CME requires a tiny $9,000 maintenance margin on deposit. And given the advantage of the house-managed illegal position concentration, which Bart Chilton talked about, it's been agreed multiple times that they have an excess position concentration, which is illegal technically. This enormous level of leverage is how the house market makers, silver pit managers, have been able to control the massively paper-diluted silver market against this scattered group of speculative commodity trading advisors. First-tier liquidity providers are not stupid. Guess who's going to be on the wrong side of these bets? And currently, so a 5,000 ounces of silver is valued around $115,000. And to control it, the tiny $9,000 borrowed from the house to control each contract is historically around 8%. The implications for silver are enormous. As a result of the house running a massive leveraged, multifaceted, concentrated derivative book on these contracts, silver has become the most undervalued commodity on the planet Earth. Purely synthetic. A gold price revaluation would break the ratio trade these insiders rely on to contain these purely synthetic silver contracts, likely reverting the current ludicrous 90-to-1 ratio, 90 ounces of silver to buy 1 ounce of gold, closer to more like 15-to-1 or lower. Disbanding this ratio trade in itself would raise the price of each silver contract currently contained to the low 20s to about plus or minus $200 an ounce. This would likely force the 8% margin to increase to, at best estimate, 50% or to as high as 100%. Once again, longs would have an edge over the shorts here. If we took 3,000 gold as the revaluation point, the completely synthetic derivative determined ratio trade would be blown out of the water. The short gold or silver ratio legs would be caught up in the underlying volatility, and both sides would scramble to square positions as the entire precious metal derivative complex collapsed into absolutely unfactored, unknown territory. One way or another, once silver rises above the technical and cartel defended fracture point of $35, derivative determined ranges would implode, triggering a bid-only short covering ramp well in excess of the 2011 $50 highs. So, who would be caught out into this revaluation? Every single CTA, commodity trading advisor, who has naked short sold gold. Naked in so much as while their COMEX shorts are backed by dollar longs, these debt-laden fiat longs don't represent a deliverable NSFR-compliant gold price when called upon for delivery. So in other words, when unleveraged gold bullion is demanded for delivery, it is going to take many more depreciating dollars to buy these same fully paid for COMEX ounces, kilos, tons on the other side of these paper bets. When delivery of these paper back shorts is then called in, this is when we will see the chaos unfold.
Gold prices are forecasted to skyrocket next year in 2024 and reach a new all-time high of $3,000 an ounce. The price of gold is now on an upward trajectory and is attracting heavy bullish sentiments in the charts. The precious metal is consequently moving upward by more than 6% every day and is becoming expensive to accumulate. How might China's gold strategy influence the dynamics of gold prices in the coming years? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.